What's up, everyone? It's Scotty with Money Investing. In this video, we are going to be talking about Netflix, and Netflix is going to be reporting earnings next week on April 18th, a day before Tesla, and I will be going over Tesla as well in a separate video, but Netflix is reporting on Tuesday after the markets close. The first FAANG stock, the first tech stock, the first streaming stock to really kickstart this earnings season for the first quarter 2023. So this is extremely important to set the stage and hopefully for Netflix to report some very good numbers. So in this video, I'm pretty much going to go over, my goal is to go over all the earnings, the revenue expectations, and what are some things that I'm really going to be paying attention to when Netflix reports next week. And then we're also going to calculate the intrinsic value. We're going to run through some calculations. We're going to do some fundamental analysis. And of course, technicals also in terms of the stock chart, the support, the resistance, all that stuff. So hope you guys enjoy this video and find it helpful. If you do, make sure that you drop a like. Don't forget to subscribe to the channel. If you're just joining us for the first time, the link to our Discord and Patreon is going to be down below. There is a 16% annual discount available till the end of this month. And you can access all the binds alerts, options alerts, trade ideas, everything including all the member benefits and private videos as well. So link's going to be down below. So the company in question today is going to be none other than Netflix. Netflix, a streaming giant that's been around for quite some time. We love the shows. We love the platform. Now it's time for Netflix to actually show us how many users it added and what the expectations, what the actual revenue, earnings, all that stuff looks like. So this is going to be the numbers, right? So let's just get that out of the way. And this is what the fourth quarter 2022 looked like. We pretty much reported $7.8 billion in revenue for Netflix. EPS was dramatically lower, 75% decline with 12 cents per share, and operating margins were just about 7%. Now, one thing that we have to understand with Netflix is that the fourth quarter for the company is usually the biggest burn because the content slate's pretty heavy and they have to spend a ton of cash to getting those content pretty much completed. And that's why you've got a lot of Netflix originals, Netflix series, a lot of Netflix produced content. So it's kind of like a hamster wheel, right? I mean, you've got to constantly be producing content in order to keep the users, keep the viewers entertained. So you can never take a day off, never take a week off, never take a year off. So that's a problem with Netflix, is that it cannot be automated. It's not something that, hey, the software is kind of working in the background and the business is going to keep growing. No, you have to constantly keep pumping money into the business. You got to keep producing content. You got to keep the users and the viewers entertained. That's a bit of a problem for the long-term viability, long-term sustainable path for Netflix. But that's neither here nor there. We'll talk about that, discuss that maybe on a live stream or something when we're talking about it more on a one-on-one basis. But anyway, members, 230 million is what Netflix reported in the fourth quarter 22, and they added over 7.6 million users in the fourth quarter 22. A lot of them actually came from the United States, Canada, and North America, like in parts of North America. So you can see that fourth quarter, they added close to 910,000 new paid members, so about 0.91 million, a little bit under a million. Actually, a lot of them actually came from Latin America as well. Latin America had a lot, and then we also did have net additions added in Asia Pacific. But paid net additions, we had about North America, 0.91 million. That was a 10% growth year over year. Europe, Middle East, and Africa did lose on a year over year basis, but we also did have paid net additions grow from to 3.2 million. That was a pretty substantial number there. And Latin America, we grew 1.76 million for Netflix, and Netflix also grew 1.8 million net additions. In other words, users added in the fourth quarter 22. So that, of course, is going to be the big question mark, right? In terms of how many members we actually have for Netflix, like what's the user count and the net additions, right? That's going to be the key metric there. And revenue guidance from the company's own guidance, they're projecting $8.17 billion in revenue, an EPS of about $2.82, and operating margins kind of moving back up to 19-20%. So expectations are 19.9% to be precise. And this is what the estimates are on Wall Street. $8.175 billion in revenue with an EPS of about $2.86. Two more things that I'm going to be super interested in. The guidance, of course, without a doubt, what is going to be that second quarter 23 guidance and the entire 2023 guidance, but more so the advertising business, right? So Netflix, as we know, did launch an advertising model at the end of last year. And again, it's going to be in full swing now, especially in certain countries that they launched the ad-supported tier. So numbers related to that. What is the average revenue per user? So ARPU is going to be very, very important. The number of users signed up for the ad-supported tier. What is the feedback? What is the takeaway from their advertising supported model? And is that something that can actually morph into a bigger business for the company and can actually generate more revenue, more earnings for the company as well? So that is something that is also going to be very important for the company. Now, moving forward, going over to some of the expectations. Well, we're already gone over the expectations, but valuation-wise, Netflix has definitely come down to somewhat reasonable valuations after the big sell-off. So you'll notice a 5-year average for Netflix's price to earnings is at over 60, 70, 80, 90 times. And right now it's trading at 34, 29, 34, around those levels. So it's definitely come down from its valuations. About 2/3 has been shaved off the valuation here. And price to sales, we're trading at 4.76, which has been cut in half versus the average 5-year around 7.9, almost 8. And enterprise value to EBITDA, we're trading at 27, 21, which obviously has been cut in half from 5-year average perspective, 42 and 58. And price to cash flow has almost always been a pretty big deal because the cash flows are really low for the company because they've got a pretty high cash burn, 74 on a trailing basis and 47 on a forward basis, but it's still a lot lower than its 5-year average. So valuations definitely come down for Netflix, no doubt. And these are the margins, which again remain very strong. 40% gross profit margins, about a 14 to 15% net income margin. We got a pretty strong free cash flow margin, and return on common equity, assets, and capital also very strong in the double digits, almost at 10% for these two, but over 24% in return on common equity. Now, in terms of expectations, right, for the future, Netflix, analysts are expecting for the EPS to grow for Netflix from $11.41, so $11.41, all the way up to $50.67 by 2032. That is a pretty substantial growth rate. So very nice linear growth expected for Netflix. And this is going to be the revenue expectations from $34.3 billion all the way up to $82 billion for the company. That's what the expectations are for this business, linear growth over the next 9 years. So if we plug in some of these numbers, in the spreadsheet, what you will notice that the actual growth rate expected for the next 5 years, this actually should be 2028, 5 years and as much as 9 years is going to be closer to 18 to 90%, right? That's the growth rate. That's the compounded annual growth rate for Netflix expected over the next 5 to 9 years. So when we plug in our own estimates, I'm not going to be going with 18 to 19%. I'm going to be a little bit more conservative and go with 16% for the business. But before we jump into this, I want to also mention the balance sheet's never been great for Netflix. $6 billion of total cash on the balance sheet with almost $17 billion of debt. And that gets our net debt at over $10.8 billion. So that has always been a bit of a concern. And we've got a long-term debt sitting at $14.3 billion. Current and quick ratio, current ratio is over 1. Quick ratio is a little bit under 1. And debt to free cash flow is still pretty good at 1.68. But again, cash to debt always been a bit of an issue because the company, this is one of the few FAANG stocks, one of the few tech stocks that actually has more debt than cash on the balance sheet. So that's always been something that's been holding me back from investing in this business. But now we move over to the intrinsic value calculation. Again, the 5-year, 9-year compounded annual growth rate, according to estimates from the analyst, is 19 to 18%. So let's just go with 16% just to be on the safe side. And the P multiple, look, I'm going to be generous here. I'm going to go with 25 times P multiple. That's going to put our PEG ratio at 1.56. And the discount rate is going to be 12%. 10% margin of safety, and we're going to plug in, let's just say they buy back, 0.5% in shares every single year, just to be conservative here, and we get a fair value or an intrinsic value for Netflix at $273 per share, and the market price is at $338 at the moment, meaning that it's 19% overvalued at the moment. This right here is going to be that sensitivity grade, so you can again look at that for yourself, make that judgment call whether the growth rate needs to be lower, whether the price to earnings multiple needs to be lower or higher, and you can get a fair value on Netflix and where it should really be trading at based on your estimates for PE and the growth rate as well. This is going to be that flexibility range where I am going to be flexible as low as 260 to as much as 290. That's that $30 range on Netflix, but this has been the entire chart, the entire pattern. Obviously, Netflix has been selling off since November of 2021. It's dropped a little bit over 77% and then started to kind of trade inside this uptrending channel, higher highs and higher lows. And right now we've got a very strong resistance at $380. So this right here is going to be that resistance to watch for Netflix. It's possible if they report some very good numbers with the advertising supported tier, so ad supported tier coming in with some very strong users and members and new forms of revenue, earnings beating, margins increasing. It's possible that we potentially see Netflix get as high as 360s, 370s. It's possible. I'm going to be going into this earnings a little bit more biased on the bull side, so leaning a little bit more on the bullish side. But support level and my fair value obviously is going to stay put in the 270s. So this right here is going to be that support level to watch for Netflix. But a couple things that do bother me. Number one is the balance sheet, more debt than cash on the balance sheet. And number two is going to be that constant hamster wheel model where Netflix needs to keep spending in order to keep growing, right? So their cost of acquisition is always going to, or cost of retention and cost of acquisition is always going to be high because they need to keep producing content. So let me know your thoughts down in the comment section below. Again, EPS estimates pegged at around 286 and revenues pegged at about 8.175 billion for the earnings coming up on Tuesday after the bell on April 18th, and support level and my fair value sitting roughly at 275 with the resistance and this area of targets going to be staying put at 370. And that's where we are. So hope you guys enjoyed this video. Found it helpful. If you do, make sure that you drop a like. Don't forget to subscribe to the channel. If you're just joining us for the first time, the link to our Discord and Patreon is going to be down below. As always, happy investing, and I'll see you all in the next video.